Hi, I'm Chris Wright, president of Wright Wealth Management Group. Over the past several months and years, I've had a lot of investors ask me about what happened in 2008 concerning their investments with other firms. Today I'd like to focus in on passive management, what that means, and why most investors adhere to this passive management or buy and hold strategy that you hear so often about. Most investors in their portfolios in 2008 lost somewhere between 30 and 50% in their portfolios. Why did that happen? Most investors felt that their mutual fund companies were maybe looking out for them and were going to make their portfolios more conservative as the stock market began to crash. As I started to hear these questions and as investors came in my office, I started to do some investigating about passive management or mutual fund investing as a whole, or index investing as you hear so often about, and how those portfolios really respond to markets that are extremely volatile or markets that are bearish. It seems that most investors had no idea that in order for them to get out of their current holdings in the market, that they had to call their financial institution or financial managers and ask them to remove them from the market and maybe move their money into a money market fund. But as many investors experienced in 2008, as they called their financial firms, they were simply told what I refer to as the number one phrase of 2008, which was hang in there, ride it out. The market will always come back. I've often wondered if every telephone line was recorded in the U.S., if that would have been the most common phrase of 2008, because most investors called their financial individuals and heard that phrase, hang in there, everything will be fine. Well, luckily everything did come back, but it was a tough pill to swallow as investors saw their portfolio deteriorate maybe 10% down to 20% down, and then all of a sudden they were 40% down. Sometimes hanging in there and riding it out is not a risk management strategy. It is not a tactical strategy. But the problem is that we felt as investors, you may have felt as well, that your diversification was going to do enough for you in protecting your portfolio from going down. So why do we diversify? Well, with passive managed portfolios, we believe, or you may have believed, that diversification would be enough if the market turned and went south. However, most investors realized that their diversification didn't really do anything for them in 2008 because the non-correlated assets of their portfolio became correlated and acted as a whole, and the entire market went down as a whole. As investors started to realize that their diversification did not do enough for them, they started to ask additional questions. Why did not my financial firm protect my portfolio from going down? Why did my mutual fund company not get me out of the stocks in that portfolio and move me to the sideline? Well, the answer is really inside the prospectus of each fund. Most investors get these 4x6 prospectuses concerning their mutual funds in the mail each year, maybe semi-annually. The answer is really hidden inside that prospectus, that the objectives of the fund have to stay consistent with the risks and the objectives associated with those investments. For instance, if a mutual fund is called a stock growth fund, the investment will seek the objectives of investing only in growth stocks. And if you read within the pages of that prospectus, it will tell you generally that the fund has to maintain a certain percentage in growth stocks. For instance, if the fund states that it needs to always be invested with at least 80% of the fund's money in growth stocks, it's not going to have the ability to sell those stocks off and move into a money market fund if the market becomes extremely volatile or bearish. Therefore, if we're doing a lot of index investing or mutual fund investing, the fund has its hands tied or has handcuffs on the fund to be tactical and to move to the sideline or to a money market position to protect the investor's money. As I started to hear more and more about this from investors in 2008 that had invested with other firms, I started to do some investigating myself about where this idea came from that we always have to just buy and hold and hang in there and ride it out. Where did that philosophy come from? In my mind, that philosophy started in 1952 with a gentleman named Harry Markowitz at the University of Chicago. And what he basically stated was that if we had a well-diversified portfolio of stocks, bonds, cash, international, commodities, currency, if we have different pieces of pie within our pie chart, if you will, that simple diversification of non-correlated assets would protect us from major downturns in the markets. Maybe that works for some, maybe it doesn't for others. The problem in my mind with the philosophy of buying and holding forever and ever is that different allocations or different sectors of the market perform at different times. For instance, if we have a portfolio that's a 50-50 blend, which is a popular portfolio, or a 60-40 blended portfolio you hear so often about, it basically means that if 50% of our portfolio is in stocks and 50% of our portfolio is in bonds, those two sectors are generally inverse related. So if stocks are going down, bonds generally go up. And if stocks go up, bonds generally may be flat or go down. So why have we been taught that for the last 70 years, we need a type of portfolio that has these inversely related sectors of the market, and really at any given time, only one portion of our portfolio is performing? That's really what is happening in my mind with passive management. Maybe it makes sense for some, maybe it doesn't make sense for others. But to have that approach of passive management as a one-size-fits-all strategy, to me doesn't make a lot of sense, especially as investors are getting closer to those magic years of retirement age. I'm Chris Wright, president of Wright Wealth Management Group. Thanks for joining us this day concerning passive investment management. And please stay tuned for our next podcast where we will be discussing active and tactical management strategies.